Hi everyone, it's Paul Tilley and welcome to our explainer video for the first assignment in accounting. This assignment has a bunch of questions in it that really relate to the material that we've covered in the first three chapters, and it really is the fundamental basis for which accounting happens. So it's very important that you'll understand the concepts that are talked about in this assignment. What I want to do today is I will bring you through each of the questions and show you the solution strategy and how we work towards rationalizing these particular types of questions. The very first question asks about Jack Tasker. He opened an auto repair shop in November 23. The balance sheet at November 30th was prepared by an inexperienced part-time bookkeeper, shown below. And you say to yourself, okay, this is a balance sheet. We know it's a balance sheet because assets equal liability plus owner's equity. Now, a balance sheet is a snapshot of what the company is worth on a given day, okay? And we need to be able to sort out what's an asset, stuff the company owns, what's a liability, stuff the company owes to outsiders, and what's an owner's equity, stuff the company owes to the owners. Now, keep in mind, why do we do that? Well, the fact is that a company is considered an entity, and we want to be able to show the value of the company to the owners. And this is how we do it. Assets will always equal liabilities and equity put together. So assets equal liability plus owner's equity. So let's take a look at each of the accounts. The strategy here is really to look at each of the accounts and determine, is this an asset account? Is it in the right place? Is it a liability account? Is it in the right place? And is it an owner's equity account? And is it in the right place? And if it's not in the right place, that's our job to put it there. So what I'm going to do is create this little matrix here, which will give us an idea of where our accounts are. Okay? So in the first instance, we see cash is under assets. Now, cash is something owned by the company, so it is an asset, and it's a pretty liquid, meaning it can be turned into cash very easily. It is cash. So that's in the right place. That's an asset, and it's under the asset column. So let's put in cash, and that will be $81.50. Now I'm going to dispense with dollar signs and these sorts of things for the purposes of this illustration, okay? Now, let's move down to the next one. Accounts payable. Let's think now, a payable is something that you owe somebody. It's a payable, meaning you pay it to someone else. It is certainly not an asset. An asset is stuff that you own. However, it is payable to someone else, which by definition is a liability. So actually, accounts payable should be in the liability column. So I'm just going to write a P here, and that will be for $36,700. Okay? Now, let's move to the next one. Equipment. Equipment is stuff that is used to help make the company money. It is, by definition, an asset. It's owned by the company. $27,000. Okay, so that gets put under assets. Let's move to the next one. Jack Tasker, capital, $29.40. Capital, by definition, is money that's owed to the owners, and that falls under the owner's equity section, not the asset section. And that will be $29,400. So we move it over there. Okay. So that's total income. Now, income is not necessarily reported or not reported. Income is not reported on the balance sheet. The balance sheet is a measure of assets, liabilities, and owner equity. Income is an income statement amount. And if we had income at all, it would be shown there, not here. So this is not the total income here. This is actually total assets, or it should be total assets. So we're going to add up our total assets in a minute now, as soon as we get through them all. Over in liabilities and equity, under this column here, they have parts and supplies. 1460 as a liability. Liability, keep in mind, stuff that's owed to outsiders. Equity, stuff that's owed to insiders. Parts and supplies is stuff the company uses to do what it does. It's really an asset. So parts and supplies should be found under assets, and it's 14,600. Moving now to the next one, accounts receivable. That's money that's coming into the business. It's flowing into the business, and because it's flowing into the business, it is basically owned by the business. People owe us money and they're going to pay us. So it's going to come in. That's what we'd consider as an asset. So 51.5. Finally, we see mortgage payable. Mortgage payable is 36,150. That's a payable, meaning that's money we owe to someone else, and it's owed to outsiders. So mortgage payable will be falling under liabilities. And it'll be $35,150. Oops. Wow. It'd be $35,150. Okay. So you can see here we've got all of these items. Down here we've got total equity. No, it shouldn't be total equities. It's actually total liabilities and equity would get added there. So now that we've sorted all of these into the categories, we really need to do a little bit more here. Normally when you think about the assets, assets are always listed from a most liquid to a least liquid. In other words, stuff that can be turned into cash quick. Accounts receivable is a fairly liquid item, so I'm going to put liquid items up front. So now parts and supplies is probably more liquid than equipment, meaning that we can sell it for cash if we need it to. That's what we mean by liquidity. Okay, so effectively then what we've done here is we put our most liquid at the top of the assets, our least liquid as we move down. So we got cash, accounts receivable, parts and supplies, and equipment. For a total, if we added those together, let me clean up this, let me move this up a little bit. If we totaled all of those up, we would come up to 101,250. That's the total of all these numbers. Now, how do we know we've got it done right? Well, one of the things that we need to be able to do is to say, do assets equal owner's equity? So we can go in and add up 36,700, 35,150. That's our total liabilities. Add that to our total owner's equity, 29,400, and we add that up, and it comes to 101,250. The balance sheet is in balance. Assets are under assets. Liabilities are under liabilities. Owner's equity is under owner's equity. That is how you resolve that problem. Okay, let's take a look at number 2. Blue Water Kayak begins operations on January 1, 2022. The owner invests $27,000 during the first year and is able to withdraw cash to $67,500 after a successful first year. That's great. During 2023, the second year of operations, the business reports a profit of $192,000. The owner withdraws $86,500 and no owner's investment, so he didn't put anything back in. In 24, the third year, Blue Water Kayak incurred a loss of $6,700. The owner made no withdrawals and no investments during this period. At the end of 2024, the owner's capital was $137,000. Then it says required, calculate the profit or loss for 2022. Okay, so the way you have to look at this and you say, okay, this is over a period of 3 years, right? And we can see that there's money going into the business, money generated by the business, money coming out of the business, and at the end we have an amount that the owner owns $137,000. So what we need to be able to do is to create a table, an effective table, that allows us to review what the owner put in and what the owner took out of the business. The owner invested $27,000 during the first year and was able to withdraw cash of $67,500 after a successful first year. So we're going to take the owner investment. So he took $67,500 out of it. Okay. Now, that's basically what happened in 2022. We don't have any more information there for 2022. Let's move down to the next one. During 23, the second year of operations, the business reported a profit of $192,000. So here's our profit for 2023. That's $192,000. Owner withdraws of $86,500. Okay. And no owner investments. Okay, so owner investment, 0. That's all those covered off. Let's take a look then at 2024. 2024, the third year, Blue Water Kayak incurred a loss of $6,700. So this would be minus $6,700. The owner made no withdrawals, 0. And no owner investments during the period, 0. Okay. At the end of 2024, owner capital was $137,000. Okay. So what we have here is all the information that's given in the problem put into the table. So effectively, what we have to do is to work backwards through time in this table in order to calculate the profit or loss for 2022, right? So we have all the information of 24, 23, and 22 that we have, but we can deduct the rest using this equation here. So in the instance of what's going on here, 137 is the ending, minus 67. So effectively, then we can calculate that if we took 137 and we added the 6,700 to it, we would get 143,700 as a beginning capital balance. Again, we're just working backwards, so we're adding that back in. That comes to 143 would be the beginning capital for 2024. The beginning capital for 2024 would also be the ending capital for 2023. Okay? So we got to add these things back in order to get the beginning capital for 2023. So we add back the 86,500, subtract off the 192,000, and that will give us 38,200. So that's where that comes from. This is a calculated, again, a calculated number. I'm just going to highlight the calculated numbers in red. Okay, I hope you're following along here now. This is the basic equation, and if we work the equation backwards, we add negatives and subtract positives, basically, in order to get 38,200 would have been the start here. Now, the beginning capital for 2023 would also be the ending capital for 2022, 38,200, right? That then, we would add back the 67,500. In 2022, there was 27,000. The beginning capital for 2022, we're going to say was 0 because there was no company before that. So what we do is we say, okay, 38,200 plus the 67,500 plus whatever the profit, subtract 27,000 will give us 0. So effectively, what is it that makes that equation work? So if we did the numbers on that, we would get 38,200 plus 67,500. We'd add that back, minus the 27,000. That would give us 78,700 as the amount in that cell. And that amount in that cell is, by definition, the profit for the firm. So we deduct, based on our analysis here, that the profit for 2022 was 78,700. Let's take a look at question number 3 next. On August 1st, 2022, Cross Fitness entered the second year of operations. Cross Fitness provides high-performance group and personal training courses, and all those have been derived from scientific research and all that stuff. On July 31, 2023, J. Gray, the owner, finalized the company's records, which showed the following items. So what we have here is a list of accounts, and a list of accounts only. This would be considered what we know as a trial balance. So we have accounts payable, accounts receivable, J. Gray capital, J. Gray withdrawals, cash, furniture, interest expense, notes payable, workout equipment, prepaid rent, rent expense, personal training revenue, group training revenue, supplies expense, utilities expense, and wages expense. So now all of these are at the end of July. And it says, hint, the ending capital balance for one period is beginning capital balance for the next period. There are no owner's investments during the year. Okay. So what we need to be able to do then is prepare the income statement first. So what we're saying here is, look, we've got a bunch of accounts, and we can use those accounts now to calculate the income statement. How do we do that? We have to pull out all of the revenue and expense amounts from that file. Okay? So let's take a look. Let's just draw. What I have done is I've just put together a little table here. And what I want to do is to find all of the revenue accounts first of all. So looking through the list here, I see we got group training revenue. We've got personal training revenue. Those would constitute the two revenue accounts, okay? So let's put them in here. Group revenue and personal revenue. Okay, so the group revenue was $183,500. And the personal training revenue was $8,500. Now, I don't see in this listing here that I don't see any more revenue accounts. So if we add up our total revenues, total revenues come to 190. That's wrong, okay? So group revenue is 183.5. Okay, you got to start over again now. So personal training revenue was 9,500. Hard to see the list here. 9,500. So total revenue then would be 193,000. Okay, so this is a total right there. So let's just bold that. Let's now take a look at expenses. What expense accounts have we got here? So these would be wages, okay. Wages expense was 71.5. We've got rent expense, which is 31.5. I'm just sorting them really by highest to lowest. We've got supplies expense. Supplies expense comes to 19,400. We've got utilities. And utilities expense is 13.3. And we've got, what else have we got there? We've got interest expense. Interest expense is 5,500. Now we added up our total expenses. We take all of these, we add them up, Total expenses will come to $141,300. Okay, that's our total expenses. So I'll just bold that. I gotta put in one more. Okay, so profit is revenue minus expenses. So profit would be revenue minus expenses, which is $51,700. Okay, so there is our income statement. Okay, that's our income statement that we have now calculated. So the equity statement is a measure of how much the owner owns of the business throughout the year. And we've seen that we start off with the beginning equity. We add in profit for year. We add in the owner investment. And we subtract any losses. And we also subtract any owner withdrawals. Okay. So considering this, we start off with our beginning equity. And if we look through our list here, we can see that the beginning equity in 2022 was $82,800. The profit for the year, if we go back and we look at what we calculated here, and I should say this is for the year ending, okay, July. Keep in mind now the income statement measures for the year. So the profit that we calculated was $51,700. So let's go add that in. Okay, we add that in. There is an indication that if we look at the listing here, is there any indication that the owner put more money into the business? No indication here that there was any money put into the business. However, there were withdrawals. There were no losses for the year, so there's no investment, no loss for the year, and we have a withdrawal from the owner of $63,500. Okay, so we got to make that a minus. So what we'll get at the end of the year is the equity on July 31st, 23 would be 82 plus 51.7, 82.8 plus 51.7 minus 63.5, and that will be $71,000. So that's how you calculate that one there. Okay? Now, considering that we've looked at the income statement and the statement of equity, we can now go on to calculate our balance sheet, and keep in mind. So keep in mind now our balance sheet is made up of three distinct parts. We got assets, okay, and we've got liabilities, and we've got owner's equity. So let's list down our basic assets that we have. I'm just going to put them here because I don't know if I have enough columns. If we look at the assets, we look through our list and we say, what are assets, things the company has? Well, first in our list is accounts receivable. And the accounts receivable is showing there at $77,000. And then we look through our list some more, we'll see cash. Now cash is more liquid in an accounts receivable, so I'm just going to put it up above here. Okay, and our cash, if I got it correct at all, our cash was $9,100. Okay. And then we look down our list some more and we see what else we got here. Okay. Furniture, $16,700. Okay, we look down our list some more. Workout equipment, that's an asset. And if we think about what workout equipment would be, it would be $22,700. Okay. The other thing, what else we got down? As we go down to our list, workout equipment, prepaid rent. Now, prepaid rent is rent that we paid ahead of time, so it's good. It's it basically we have our rent already paid, so let's consider it an asset. It's fairly liquid, so we're going to put that in as well. And I'm going to put it at above furniture. I'm going to put it prepaid. Anything that's prepaid is an asset because it will last you in time. It has value. And prepaid rent was what? Prepaid rent was $7,500. And what else we got? Supplies is there as well. Supplies and prepaid rent are fairly liquid. You probably could sell them if you had to. So let's put supplies in the middle. And supplies, if we look at supplies, that was $5,900. And there, basically, those are all our assets. So those are the amounts that show up in our balance sheet as having value that we can use. So if I total up the total in terms of that, okay, I'm just going to write it here. Total assets, it will come to $138,900. Okay, so that's our total assets according to the sheet. Okay, now let's just move our liabilities. I'm going to take our liabilities here and I'm going to move it up here. So that's one end of our balance sheet. Now we'll look at our liabilities. And what kind of liabilities do we have? Liabilities, stuff we owe people, outsiders. And we look through the list. Accounts payable is a liability. I just put AP for short. And it's $12,900. And I look at our other payable here. Oh, there's a payable, notes payable, $56,000. I'll just call it NP. And that's 56, 55. Notes payable is $55,000. Gotta get my eyes lined up. Okay, so that's liability, and then if I look, I think that's the total. That's all the liabilities. So total liabilities is two of those added together is $67,900. Okay, so our total liability is $67,900. And if we look at owner's equity next, let's just insert a row below there, a couple of rows. So if we look at owner's equity, now owner's equity deals with what the owner is owed by the business. And if we look through our list, we got the capital account, and we calculate it. We calculated the capital account. If we look at these, like if you look in the list, capital at the start, withdrawals, all those, we've got all that summarized in this account right here. So we know in this equity statement, we know that the total equity is $71,000. So all we need to do is plug in 71,000. We could do it. We could break it out just like it's done there in the statement of equity. Okay, so now I got three things here. I got total assets, total liabilities, total owner's equity. If I added up total liabilities and owner's equity, you will find that the total liabilities plus owner's equity comes to $138,900. Now you'll notice too that that balances the total assets as it's supposed to. 138, 138.9, 138.9. So that is the solution to our problem. We have calculated the balance sheet, we have calculated the statement of equity, and we have calculated the income statement. So next we'll take a look at number 4. The accounting records of the Clear Delivery Services shows the following assets and liabilities at the end of 2023 and 2022. So we got 2 year ends. You can see December 31st, 23, December 1st, 2022. The various accounts are listed there, and the value is in those accounts. And it says, during December of 2023, the owner, Jess LeClaire, purchased a small office building and moved the business from her rented headquarters to the new building. The building and land it occupies cost $130,500. The business paid $69,000 in cash and made a notes payable for the balance. LeClaire had to invest $18,400 cash in the business to enable her to pay the $69,000. The business entered a profit and earned profit, which enabled LeClaire to withdraw $2,400 per month to pay personal expenses. Prepare the balance sheet. Okay, so we've got to prepare the balance sheet for the end of 2022. We've got to prepare the balance sheet for the end of 2023, and we've got to calculate how much profit was earned. Okay, so we got to take a look at this problem in terms of its key components again. So all of these, we really need to look at their key components. First and foremost, what we need to do is to take this information here and put it into a balance sheet. Okay, so what I'm going to do is I'm going to set up a spreadsheet that kind of illustrates how to answer this question. So the very first thing we need to be able to do is to create a balance sheet. Now, our balance sheet, if you recall, is at the year end. So this is December 31st, 2022. So it's at a date in time. So first of all, we're going to lay out all the assets. What are some of the assets here? Well, cash. I'm not going to. And then we have liabilities. And keep in mind, liabilities is what's paid to outsiders. So let's take a look at what's in that list that's just liabilities. Well, if we think about liabilities here, we've got accounts payable, which are payable to outsiders, and notes payable. Notes payable and accounts payable are almost the same thing. Accounts payable tend to be shorter term. Notes payable tends to be longer term items. So, and we got total liabilities. Okay, and then we got owner's equity. So here we are. Let's put some numbers in for December. So in this particular instance, and here's what we found. We've got total assets of $159,450. We've got liabilities totaling $4,200. So we asked ourselves, well, what's owner's equity? We don't know. It's not written here, but we do know because assets equal liabilities plus owner's equity. So if we were to do this simple calculation then of saying, okay, let's take the assets and subtract off the liabilities, the difference between the two must be calculated to be, and I'm going to put that, must be $155,250. That's just derived from the calculation. Okay? Now, this is again for December 31st, 2022. We also have the information for December 31st, 2023. Our capital, by definition, then, must be 192,300. Again, assets minus liabilities will give us 192,300. So the next part of the problem asks us to calculate the profit. Okay, what is exactly the profit? Let's see what we got in terms of information. Normally, in order to calculate profit, we go looking for the revenue in the year and the expenses in the year. Revenue less expenses will give us a profit. Looking at this problem, we just don't have that information. But what do we have? What do we have? Well, we have information with regards to owner's equity. We know the owner's equity in the beginning year. So let's say, for example, 2022 owner's equity. At the end of 22, we know that the owner's equity then was 155,250. Okay, we determined that. We know too that the owner's equity in 2023, at the end of 2023, was 192,300. Wow, there's a difference there. Okay, there's a difference there between the two. So we know something happened to change owner's equity. Well, the only way that owner's equity can change is profit. Okay, or owner investment. In other words, the owner puts money in the business, or owner withdrawals. Okay, so let's just figure out what happened. Well, we don't know the profit for year. We know we don't know that. But we do know that the owner made an investment of $18,400 into the business. We certainly do. We also know the owner withdrew $2,400 a month for 12 months, and that comes to a total of $28,800. Okay, so this would be a negative amount. Okay. Okay. So considering that, then, we started with 155. We had 18,000 put in, and the owner withdrew 28,800. Okay, so let's size this up. So if we were to get a sum of that, okay, so what we're doing is we're adding up those numbers there. And that sums to 144,850. Okay. So we know at the end of the year, the owner's equity value was 192,300. So we know summing it comes to 144. The owner's equity stated is 192. The only thing that could account for the difference would be profit. In order to calculate the profit, then, the difference between the two. So profit would simply be the 192 minus the 144, and that would give you a profit of $47,450 for 2023. And that's how you figure that out. Okay, well, let's take a look at number 5. George Littlechild started a kitchen and bath design business called Littlechild Enterprises. Following activities occurred during the first month of operations, March 2023. So we have 1 month of operations here. And you'll see that A through I involve things that happened in the business. These are things that need to be recorded. A, Littlechild invested $205,000 cash and office equipment valued at $29,000 into the business, and so on. So we're going to go through each of those sequentially. Now, they would each create a change in the various accounts of the business. So what we need to do is to look at a table here, and we're going to record the changes in the various accounts as the A through I events occur. So what I want to do first is to create a table. So I'm just going to do this very quickly here. Okay, so here we are. We have completed the basic design of our table. So what we're going to do is, as we move down through, we're going to record each of the relative entries. So in the first instance, the little child invested $205,000 cash in office equipment valued at $29,000 in the business. We have to ask ourselves, what's going on here? Well, first of all, if he puts under one, if he puts cash in the business, that's $205,000 in cash. And he also put office equipment in the business at $29,000. Okay, so that would be towards that. Now, if we ask ourselves, okay, here's the asset he put in. What's the corresponding amount in liabilities or owner's equity that would affect it? So in this particular instance, he is investing this, and this contributes to his owner's equity. So the total owner's equity then would be $234,000. So if we added these two together, you would see it comes to $242,000. With 200, if we added these two together, you would see it comes to $234,000. Okay. Now that's his first one. In the second instance, it says purchased a small building for $690,000 to be used as an office, paid $145,000 cash, and signed a notes payable for the rest. So we have a new building. So this is great. So the asset would certainly be the building, okay? And the asset for the building would come in at $600,000. Just let me make sure that that's right. $690,000. $690,000. There's an asset for the building, and the he paid cash of $145,000. Okay. So that would bring our cash down. And he also took out a note payable of $540,000. So effectively then, we have to ask ourselves, do liabilities and owner's equity equal? 690 minus the 145 is $540,000. Yeah, the notes payable of 500. So we look at this and we say, okay, do this equal. We got 690 minus 145. Did that. 545. And the other side of the equation, it balances. Third element. Next, purchased $3,900 in office supplies for cash. So in this particular instance, the cash account went down for $3,900. And in this particular instance too, the office supplies account went up by $3,900. Ask again, does it balance? 39 minus 39 is 0, 0, that would balance. 4. So next, we are purchased $81,000 office equipment on credit. Well, this means that you got office equipment for $81,000 and credit. Credit means that you're going to pay for it later, and that will be an accounts payable for $81,000. Does it balance? 81,000 on this side, 81,000 on that side. Yes. Okay, the next one. Made renovations to a hotel hosting at the hotel hosting a kitchen bath design conference on August 23rd. He'll spend $1,900 to visit. So made reservations. Oh, little child made reservations at a hotel hosting a kitchen and bath design conference in August 23. He'll send $1,900 deposit on July 1st. Okay. This is a reservation. He hasn't done anything, so there's really no need to do anything here because there's no commitment of cash. Okay, so there's no effect. Completed a project on credit and billed the client $6,100 for the work. Completed a project on credit and billed the client $6,100 for the work. So we go here. Project for $6,100. This would have been accounts receivable. $6,100. Someone's going to pay him. And seeing its revenue really coming into the business, and that would affect his owner equity. $6,100. Paid a local online newspaper $4,400 for an announcement. Office been opened. Okay, so paid a local newspaper. This particular instance, it would be cash would go down. And seeing it's going to draw money out of the business, it would negatively affect owner's equity. Yeah. Completed a project and a client collected $4,900 cash. So in this particular instance, he got $4,900 cash. And this is going to affect his capital in the sense that that's money to the good. His business has gone up in value. Okay, next. Made $4,900 payment on the equipment purchased in the previous one. So he's made a payment. So this would mean that his money would go down by $4,900. And his accounts payable, money he owed to someone, this is this right there, would go down. Okay. Received $2,950 from a client described in F. So this is money coming into the business. So $2,950 comes in. And that client had bought it previously on credit. So it'd be $2,950. Cash gone up. And his accounts receivable, because but he paid some of the money. It's gone down by $29.50. Okay. 10. Paid $8,800 cash for office secretary's wages. Make sure that's right, $8,800 cash. So cash is going to go down by minus $8,800. And in this particular case, then this is an expense out of the business, and the expense would draw money down from his equity. And finally, little child withdrew $49 cash from the company's bank account for personal expenses. $4,500 cash. Little child withdrew $4,500 cash. This is going to affect his owner's equity. It's $4,500. Okay. Now that we've done all that, we're just going to add them all up. Now we're going to go and I'm going to run the calculator here to. Okay, so the second part of the question says, prepare an income statement. Okay, so we need to think about our income here. What's going on in terms of income? So an income statement, it will be for the period. Okay, and that ending March 31st. So what do we got in terms of revenue? Well, if we think about our revenue, we thought about our revenue, we had a service revenue in terms of all the ones that affected our revenue. So if we look now at our income statement for the period, okay, our revenue, we had service revenue of $11,000. If we think about where that service revenue came from, we did some work for $6,100 and we did another bit of work for $4,900. Two of those combined together, service revenue of $11,000. Our expenses, we paid wages of $1,800 and we paid advertising of $4,400, and we, as a result, would generate a loss of $2,200. In terms of changes in equity, we had a beginning equity of $234,000. Nothing was added. We lost $2,200 in operations, and the owner withdrew $4,500. So the ending equity is just simply these things added in or subtracted off accordingly. It gives a total ending equity in $227,300. So in order to calculate the ending balance sheet, all we really need to do is to look at the balances in our accounts at the end. Here it is right here. We'll pull out the various items. So let's start with cash. Okay, cash. And the cash was $41,350. Now, keep in mind, assets has to equal liabilities plus owner's equity. If we take these two numbers here, we add them up, $848,400. Does it balance? Yes. This then is the ending balance sheet. Okay, let's take a look at number 6. Manny Gill, an entrepreneur who started West Secure, a business that provides security guard services. West Secure incurred the following transactions during July, the first month of its operations. On July 1, the owner put money of $4,600 into the company. On July 10, they purchased $2,100 worth of security equipment on credit. On July 12th, they performed security services and received $12,000 cash. On July 14th, they paid for the expenses. July 15th, completed security services for a graduation event. and billed the client for $1,300. And on the 31st, the owner withdrew $210 for personal use. So effectively what we're asked to do here is to record the journal entries and prepare a trial balance and then prepare an income statement. So let's go through the process. In this particular instance, what we need to be able to do then is to actually journalize the events as they occurred, okay? So I'm just going to go over to my spreadsheet here now, and we're going to consider the journal entries. So in the first case, case number 1, what happened is on July 1, so we date it, the owner put money into the company. So cash, which is the asset, went up. So we debit cash. Cash would be a debit, and it would be debited for $4,600. Now on July 1, too, that $4,500 also increased the owner's equity in the firm, or call it capital for this term, and that would have been credit for $4,600. Okay. On the second entry, which occurred on July 10th, was the purchasing of some equipment. They purchased equipment on credit. So they got the equipment. So the debit would be the asset credit. The asset would be debited. And the asset in this case was equipment, and it was for $2,100. And we would credit then the accounts payable. $2,100. Again, an asset that goes up is debited. In the case of an accounts payable, that's a liability. A liability that goes up is credited. The third item, July 12th. On July 12th, there was money made for doing a concert or doing some sort of a service there. We got cash for it, so cash of $12,000. And this would have been revenue earned. And that would have been for $12,000. Again, the asset cash went up. That would be a debit. The revenue went up. That would be a credit. 4 would occur on July 14th. Now, in the case of July 14th, we saw some expenses being incurred. The expenses were for $3,100. So we're going to debit expense. And that was for $3,100. And we are going to credit cash for $3,100 because they paid in cash. Now, again, you ask, why is something a debit? Why is something a credit? Well, an increase in an expense is a debit. A decrease in cash, in the case here, would be a credit. Okay, the fifth item occurred on July 15th. And that would have been, first of all, we would have done some work and someone's going to pay us later. So that's an accounts receivable. Will be the debit for $1,300. And the it would have been revenue earned. And revenue for $1,300 will be the credit. 6. The sixth and final entry of the month came on July 31st. And in this case, it would have been a withdrawal by the owner here. The owner took some money out, so we would have seen the capital. Murray's capital would go down by $210, and that would have been the debit then. And the credit would have been cash, because cash went down by $210. So those are the journal entries that would be required for that particular series of events that happened in July. Now, if we look at the various accounts, so what we can do is take those journals, and this is the process that we run through, and we are going to take that then and put it in what's called the ledger. So if we think about the ledger is just each individual accounts would have money coming in, money going out. Okay, so let's look at the cash one, for example. Okay, so we saw some events where cash was affected here. So cash, for example, on July 1st, our first cash event, cash went up by $4,600. So that was debited. And then we look down through, and cash on the 3rd of July was, there was another $12,000 in cash. Okay, and then on the 14th of July, cash went down by $3,100. And on the 31st of July, cash went down by $210. Okay, so effectively, this, if we could think of this as being an account of money coming in, money going out, if we were to add these up, let's just do a little sum here of these. Okay. Okay, there was 16,600 coming in, 33,10 going out. So the balance on that account, would be, in this particular instance, 13,290. The difference between that and that will be 13,290. So there's the cash ledger. So that's what that will look like when it's all done. Okay, so cash would look like that. And then we move to our next account. What would be the next account? Well, accounts receivable. Okay, and when we think about accounts receivable, what happened in accounts receivable in our list here? Well, okay, let's look. Well, on July 15th, accounts receivable went up by $1,300. And there was no more movement on accounts receivable. That was accounts receivable. That was the only thing that happened in accounts receivable. And if we look at our equipment, so let's take a look at equipment account, our equipment account. What happened there? Well, we saw equipment go up right here by $2,100. And was there any more movement in our equipment account? No. So the equipment account was $2,100, and that was the only change in that one. Okay, so that's equipment. Let's see what other account we have. We have accounts payable. Okay, let's take a look at our accounts payable. What happened in our accounts payable? Accounts payable was credited on July 10th by $2,100. And were there any other issues in accounts payable? No, no more. So accounts payable will have a credit balance of $2,100. Our next account would have been the capital account. Okay, let's see what happened to our capital account. Well, in this particular case, $4,600 credit in the first instance. And capital account was affected again by $210 on July 31st. So it went up by $210. So what would be the balance in our account? The balance in our capital account then after that bit of work was done was, oh, so our capital account was affected, and I'm going to say less withdrawals. Okay, so effectively the withdrawal was 210. So I'm going to color this first of all. Probably I'll do it this way. And so what is the balance in that account? 460 minus 210 is 4390. Okay, 4390. That would be a credit balance in the capital account. And our revenue account. Let's take a look at revenues. Let me do this. Do my coloring sometimes. Let's see what happened in revenue here. We got any revenue? Revenue 12,000, 13,000. Okay, $12,000 credit. And 1,300. Both of those were credit, so we get the balance. And the balance would have been two of those added up. $13,300. Okay. And what's the other account that we have here? Expenses. Okay, and I'm going to put this one up. Our expenses account would be, what kind of expenses we got here? Cash account, cash revenue. Expense $3,100, debit. Okay, over 3,100 there. And so our expense account, that was the only thing there. So that would have a balance, a debit balance of 3,100. So this represents all of the movements here. So we've taken each of those and put them in their individual accounts, and we got an account balance, okay, in each of those. So we can use that then. That builds the basics for our balance sheet, okay? We need to be able to think about what exactly goes in the balance sheet. Well, our balance sheet at, this would be March 31st, or July 31st. Okay, balance sheet would have assets, and those would include cash, accounts receivable, equipment, okay, and we just pull those right out. So 13,290. The accounts receivable, the balance in that was 1,300, and equipment was 2,100. Okay. And then if we look at our liabilities, okay, what are the liability accounts here? These are the ones that money that's owed to people, and liability account is accounts payable. And we look at what the balance is in the accounts payable account is $2,100 credit. Okay, and our owner's equity. And when we think about owner's equity, we got capital. And the capital account balance after it was $43.90. Now, one thing we're missing here is to say, okay, where is our profit? Okay, so we don't know what our profit is when we do our balance sheet yet, but let's go over here and do our income statement. Okay, we're going to have revenue, and that's for the period, right? So our revenue, if we look at our revenue count, where is revenue here? 1330. And our expenses expenses is $3,100. So our profit is the difference between the two. I'll make this negative so I don't have to be fooling around there as we go. And now we're going to add that up. So that means our profit was $10,200. That profit gets put into your balance sheet as an increase to the owner's equity, because again, profit. If we add up our owner's equity here now, as I've done, 14,590 plus 2,100 okay, let's liabilities plus owner's equity. That would be simply that plus that, 16,690. And 16,690. The balance sheet balances on a profit of $10,200. Okay, let's take a look at the final one, number 7. And this is really a simple question where we have to consider journal entries for 5 different events that occurred during the month of August. First of all, Joseph Earl, the owner, invested $25,000 cash into the business and added photography equipment with a fair market value of $47,000. Then he rented a studio, paying $13,500 for the next 3 months in advance, so he prepaid his rent. He purchased office supplies for $2,050 cash. He received $9,450 in photography revenue, and presumably that was cash, and he paid $1,450 in August utilities. So let's consider the journal entries that will be required for that particular one. So in the first instance, for example, he's going to invest $25,000 into the business. So if we were to think about the first journal entry, and this would be August 1st, he was going to put cash into business. Cash is going to go up, cash should be debited, and cash will be debited for the amount of money, which was $25,000. He also brought photography equipment to the business, and that also went up, and that's an asset, and the asset, like cash, any increase in asset is a debit, so photography equipment. And that was $47,000. Together, that was $72,000 worth of capital that he put into the business. So the credit will be capital for the total of $72,000, which is his ownership in the business. The second journal entry, which occurred on August 1st as well, was he paid his rent. So he's paying his rent in advance. So we're going to call that prepaid rent. And that prepaid rent will be an amount of $13,500. Why is it called prepaid rent? Well, the thing is he paid it in advance. So if he shut down tomorrow, he would get that money back, presumably, right? So it has useful life to him. It's an asset. Asset goes up. And he paid for it in cash, so his cash went down by the corresponding amount, 1,350. The third element that he did was the 5th of August. He went out and he bought some office supplies for cash. Office supplies is an asset. It will be debited, and it goes up by the amount he paid, $2,050. Now he paid for that with cash, so he just lowered his cash. Cash going down as a credit, so that's $2,050. The fourth item that occurred was on August 20th. He went and he did some services and he got paid for them. $9,450 cash. So his cash went up by $9,450. and his revenue would go up as well, which would be a credit of $94.50. The fifth element that took place that August occurred on August 31st. And in that case, he paid his utility bill. So the utility expense would be the debit. It's an expense. Increase in expense is debit. And that would be $14.50. And he paid for it with cash. So his cash would go down by $14.50. Now, that's exactly what's asked for in that problem. We don't have to go any further than that. So you should be able to get this far pretty straightforward. And there's the assignment.